And it is time to connect the dots, where we go beyond the headlines and help you learn a little something. You know, why not be smarter on a Monday morning? One of the big stories last week was that stock price drama with GameStop. I feel like I heard it everywhere I went. Somebody was talking about GameStop last week. And so, yes, it has leveled off, but the scenario could happen again.
And in fact, it's happening right now this morning. It's the silver. There's a run on silver. We'll talk about that more in the coming days. So you may start hearing some Wall Street terms a lot more often. Stephanie Whitfield is breaking out the trading dictionary for a vocabulary lesson, because Wake Up Central helps you wake up smarter.
With the battle over GameStop stock making headlines, we're seeing a lot of investing terms being thrown around. But what do they mean? Let's connect the dots. This whole controversy started when individual investors on Reddit noticed that GameStop stock had been shorted by some big money hedge funds. Financial experts say those hedge funds essentially gambled, betting the stock price would go down. When you short a stock, you borrow it for a set amount of time from someone who owns it, then sell it to someone else for a premium. When it comes time to return the stock you borrowed, you buy a replacement to return to the original investor. If you are right and the stock price is down, you buy it back at a cheaper price and pocket the difference. But if that stock doesn't fall, it's called a short squeeze. Those investors have to buy the stock back at a higher price and return it to the original investor. And that's the backstory with GameStop. Retail investors drove up the price right before hedge funds had to make good on those shorts. Now the hedge funds have to buy back stock at the higher price. That'll drive up the stock even more, making those Reddit investors a little bit richer. Connecting the dots, I'm Stephanie Whitfield.